Traders Corner is brought to you by IG.
Welcome to Traders Corner. As always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, let's start off with maybe the nature of the market at the moment, because last night on Stockwatch I was chatting to Chantal Marks and Gary Boyson, and both of them used the word weird for the market, and it's not so much weird as just completely confounding, because everything relates to the political environment, which then has a knock-on effect on the rand and then on the equities market.
Yeah, that's right. It's all about the rand at the moment, and it's all about the SARS wars, what happens between the Zuptas and Pravin Gordhan. And if you can tell me what's going to happen next in that war, then we can probably gauge what the rand might do next, and then we can gauge what the market might do. But unfortunately, none of us have that information available at our fingertips. So the market's very much headline driven. It's very nervous because of what's going on at a political level, and obviously that has the knock-on effect to the currency. And be that, with all of that the way it is, it does make for a rather nervous environment to trade at the moment.
Yeah, well, I mean, talk about, okay, but before we get to some of the recent trades, I know you want to look at the S&P 500, so taking it a step away from the South African market. And this is just also, it doesn't have political factors at play. It's going nowhere.
This is going nowhere, and I suppose you're right. We stack again locally the turbulence, but then you look at this US market, it's the opposite. It's absolutely like it's gone to sleep. And if you have a look, I've shown this graph every week the last couple of weeks, and it really hasn't changed at all in 3 weeks. We've got the fact that it's moving very much sideways in very, very tight, narrow trading ranges. It hasn't had a more than a 1% daily move since the beginning of July, the S&P 500. You can see these Bollinger Bands are tightening ever increasingly tighter and tighter here, which implies that there's no volatility in the market. But that often does precede an expansion in volatility. And whether that implies a move to the upside or the downside, well, it remains to be seen. But what's interesting to note is that August is typically quite a volatile month. If you look back in the past, this August has been the August that's registered the lowest average VIX reading for the S&P 500 since 1994. Sure. So it just gives you an idea how low the volatility is at the moment in the US markets. And what's going to break it out of this narrow trading range, I don't know. But there's invariably some catalyst waiting in the wings somewhere, which could push it one direction or the other.
Well, I mean, you talked about catalysts on, what about on the local markets? And let's go back into the most recent trade preceded by a chart of the top 40. Yeah,
so this is a chart of the top 40 at the moment, which again it has changed a bit from last week. Last week I sat here in the studio and I said, well, it didn't look like there was very much that could take this market significantly higher in the near term. And I don't think that show had even been broadcast yet. And then the news about Pravin Gordhan being summoned by the Hawks broke. And of course, the currency went a whole lot weaker. And all of a sudden, the next day, the top 40 was up 750 points. So it just shows you that in the market, anything can happen unexpectedly. But broadly speaking, I mean, we've just still got the same technical picture. Since March, this market's really been going nowhere. It's trading sideways. This 45,000 lateral support level remains very important. That level was tested in the beginning of August, and the market's been moving up ever since then. So that's the way the top 40 sits at the moment. There's no particular trend to work with here. It's choppy, getting a bit overbought in the near term. But what's very interesting to note is this slide, and this is the slide that gives you the comparison between the trading action in 2015 and the trading action in 2016 on the top 40. And I just find this very, very interesting because you can almost overlay these two charts against one another, and they're almost identical in many respects. Have a look on the left-hand side. You've got your the 2015 trading action for the top 40. Big sort of head and shoulders type of pattern over there. A false breakdown in July that year, followed by a move back up above it. Like a head and shoulders type of structure. 45,000 again was the lateral support level to watch. And eventually last year in August, we got this violent break to the downside. And that saw the market selling off quite hard. Now look at 2016 on the right-hand side here, and the pattern's very similar. Again, you've got a sort of a messy head and shoulder type of structure. You got this false break to the downside. This time it was in late June. followed by a move to the upside. If we were to follow the same path, and I mean, I'm by no means saying that we're going to, because in markets, sometimes history, it doesn't repeat itself, but it sometimes rhymes, but also it sometimes doesn't do the same thing at all. But I just think this is interesting to look at. Those red circles are where we're at in terms of following the same trading action as last year. Now, it's not to say that this is going to happen and that we are definitely going to follow 2015's trading action, but I just think it's remarkable how similar this year is to last year. Even if you look at the positioning of your 50-day moving average and your 200-day moving average, you can see we're in a very similar scenario in terms of those two moving averages. So it's very, very similar to last year.
And I mean, the other aspect, which maybe we won't have time to discuss this evening, is if you had bought maybe a Satrix 40 this time last year and look at where you are now, you've gone nowhere.
Absolutely.
And
if you went even further back, you could go back to 2014 and you'd see that you've not really gone anywhere with a top 40 or a Satrix 40, other than the dividends that you would have received along the way.
All right, Garth. Now, in light of this weird market and maybe a potential break to the downside, I know that you want to talk about another option structure. There is an option structure that expires in September, but you're going to put one on for the portfolio for the December closeout. That's
right. We've got an option structure on right now which would work for us if the market went below 45,000 on the top 40. That expires in 2 weeks' time from now. So the Rand has really put a bit of a spanner in the works in terms of that one, because the market was looking a little bit vulnerable to a break to the downside. But with the Rand having weakened, I think it's probably put the prospect of a break below 45,000 on hold for now. So the likelihood is that our September options are going to expire worthless, and therefore we're going to now look to effectively push that structure out into December. So what I've done is I've done another put spread type of structure for the December futures closeout. This contract expires on the 15th of December. Okay. All right, and the strike levels are just slightly different to what we've done for the previous option structure. So I'll take you through it leg by leg. And I know these things are complicated. I know you and I were the subject of a big joke on Twitter recently, which was quite funny, about how complicated these options are. But the thing is, I've done them each quarter, and it's like an insurance policy against downside in the market. If the market were to move lower, we would do very well out of these option structures. The fact that the market hasn't broken to the downside for us has meant that most of these option structures have expired worthless for us. But that's like paying your insurance premium. You know, when the money's gone, you don't necessarily bemoan the fact that you had to pay for it, but also you don't celebrate when your house burns down either, and you receive the insurance payout. But these option structures really give us insurance against the downside move in the market, which would allow us to make a lot of money if the market did go lower.
And I suppose if you've, considering that you've put an option structure onto the portfolio just about every quarter of the last couple of years, if you didn't do one now, sod's law, the market would collapse in a heap.
Well, this is right.
And you'd be, you'd look like a real tosser, really.
Well, I would, indeed. And I don't particularly want to. So I'm going to continue to do these structures because they're very cheap to do. And they are the risk to reward ratio is excellent if they come right. So what we've got here is a table or a graph that shows you the levels of the top 40 along the bottom axis over here. So you can see we're currently around about 47,000 on the top 40, which is over there. And then on the left-hand side here, you've got your profit above the line and loss below the line. So the first leg of this option structure that I've done is I've gone long of one put option with a strike of 46,500. And that has cost me 15,459 Rand to buy that protection. And that structure will make money all the way, and it'll continue to make money all the way down to zero. The point is the market's not going to go to zero. We're not that bearish. Nobody should be so bearish. All we do is we want to put some protection in place down to a realistic level. So what I then do against this is I can sell some out-the-money put options in order to recoup some premium. Because for me to pay away that 15,000 Rand in a premium is quite a lot of money out of our portfolio to pay away. And I'm happy to sell away some of that downside participation in order to recoup a bit of a premium income to cover that cost. So the first leg that I've done is I've sold an out-the-money put with a strike of 43,500, right? And that I receive 6,768 Rand for that premium. And you can see the payoff indicated by that blue line over there. Above 43,500, I keep that premium. Below 43,500, I'd start to lose money. But of course, by then I'd be making money on the red line. Okay. Then the next one is I've sold an even further out the money put option with a strike of 40,000. For that, I've received a premium payment to me of 2,535 Rand. So far you can see I've got 2 short put options where I've received money on both of them, and I've got a long put option where I've paid away the 15,000 Rand of premium on that long put. Then finally, what I've also done in order to receive a bit of premium income is I've sold an out the money call option.
Okay.
So what I've done is effectively I've sold the wings. 51,000 strike call I've sold short, meaning that I don't think the market's going up there. And
if it were to go up there, you would lose money theoretically if you had a naked short position.
Correct, but only from 51,000 and up.
Yeah.
And for that option, I've received a premium of 3,063 Rand. So in a nutshell, if I summarize it, and I know that this thing kind of looks like the tube map of the London Underground, but we'll tidy it up so that it makes more sense now. That dark blue line is the overall payoff of what the structure looks like. So it looks like this. Effectively, this is how our net payoff looks on this structure. Between 46,500 and up to 51,000, I've paid away a total premium of 3,097 Rand. That's the net of the premiums I've received minus the premium I've paid and so on. That's my net cost is 3,097 Rand. Between 40,000 and 43,000 is where I will make my maximum profit, and I can make 26,900 Rand as a maximum profit over there. All right, and this structure really makes money anywhere from 37,000 up to about 46,500. So there's a very, very broad profitable area here. It'll lose money if the market moves out above 51,000, and it'll lose money if the market moves below 37,000.
Presumably, though, as you have done in the past, if it gives indications that that is going to happen, you would then hedge yourself.
I can certainly hedge out the tail risk on either side of these option structures. But I've got to look at it and say to myself, do I think there's a fair probability that the market might go into that profitable zone at some stage? And I think there is a fair chance of that happening in the next couple of months. This graph shows the top 40 graph then with that option structure payoff overlaid onto the top 40 graph. So there again, you can see the significance of this 45,000 lateral support level on the graph itself. Over here in the middle of December is where my option structure expires. Below 46,500, I start to make money. I make good money between 43,500 all the way down to 40,000. All right, and I think there's a fair possibility that we fall into that area at some stage during the next quarter. And if that happens, well, then I've got the ability to make money on this option structure, but that also affords me the opportunity to go long of the market, knowing that I've got this insurance in place.
Indeed. Garth, I suppose one of the issues that lay people may have with this kind of structure is that they don't actually know how to go about doing it. Yeah. So, I mean, any advice or any indication of how you might actually enact something like this for your own portfolio? Yeah,
it's a good question because you're right. These are a little bit inaccessible to the average person. They traded on SAFEX, on the derivatives division of the JSE. So it's not a CFD trade that you would typically do at a CFD broker. This is a exchange-traded product on SAFEX. And you need to get a bank to make a market. I use Nedbank for my pricing here. If you got any SAFEX broker should be able to assist you in obtaining a price from one of the banks which act as a market maker in the options market.
Yeah, and just maybe lastly, obtaining a price. I mean, the real out-of-the-money options that you've sold away, I suppose the premium that you got was less because they're so out of the money.
Yeah, that's it.
You know, which also influences how much effectively your net premium is going to be.
Well, that's it, and that's why I've had to sell 3 legs of options out the money, whereas I've only purchased 1 leg of an at-the-money option. And that's always the way options work. The further away from the money you are, the less valuable those options are. The closer to being at the money, the more valuable the option is. And then, of course, an option that's in the money becomes even more valuable.
Yeah. Okay, Garth, so to wrap things up, where does the portfolio stand?
All right, so it looks like this. We've got, obviously, the September option structure up at the top there, which is due to expire in 2 weeks' time. And in all likelihood, it's going to expire worthless, implying that we'll lose that 891 Rand premium. Last week we had a long trade on the top 40, which unfortunately I closed prior to the rand weakening, but we made some money there for last week's show. And then, of course, this week, as we've just discussed, I've done a December option structure, which expires on the 15th of December, and there we've we pay away a premium of 3,093 rand. So all in all, we're up 15% for the year to date.
And very quickly, people can subscribe to the website, well, not to the website, but to our weekly alerts to know what's happening on the show.
That's right. If you want to get a heads up on what we're going to discuss on the show each week, go to traderscorner.co.za and you'll see there's a link to a free weekly email in the middle of the page there. Go and sign up on that, and then we'll send you an email every Tuesday around about lunchtime, just telling you what's coming up on the show for that week.
Okay, great. Garth, we'll leave it there. Thanks as always for coming into the studio. Garth McKenzie is, of course, founder and editor of Traders Corner.
Traders Corner is brought to you by IG.